Gold and silver may have crossed a line that cannot easily be reversed. For years, investors treated every major price surge as temporary, another cycle that would eventually return to the old normal. But the forces now reshaping precious metals are different. Government debt, bond market pressure, changing monetary policy, industrial demand, and growing demand for physical metal are converging at the same time. And if the current shift continues, the most important question may no longer be whether gold and silver rise. It may be how high the new normal could become, because one development in the Treasury and bond markets could reveal just how much has already changed. And that is where the story truly begins. Welcome to Precious Metals Intelligence, where major developments in gold, silver, monetary policy, and global markets are examined through a strategic economic lens. For viewers who value serious market analysis, subscribing helps support the channel and ensures future developments do not go unnoticed. And before the analysis begins, viewers are invited to share where they are watching from. The global nature of this market makes that perspective particularly valuable. Gold and silver may be entering a period where the old rules no longer work the way investors expect. For years, many investors viewed precious metals through a familiar cycle. Prices would rise sharply, attention would increase, and then a correction would bring them back toward levels that seemed more reasonable. That pattern created a strong belief that no matter how high gold or silver moved, the market would eventually return to normal. But the meaning of normal is now becoming harder to define. The reason is simple. The financial system itself is changing. Government debt continues to grow, interest costs are becoming more important, and bond markets are facing pressure from the size of borrowing required to support government spending. These issues matter because gold and silver are not only commodities. They are also assets that investors often turn to when confidence in currencies, debt markets, or monetary policy begins to weaken. Gold has historically played this role for thousands of years. When confidence in paper money falls, gold can become more attractive because it does not depend on the promise of a government or a central bank. Silver carries a similar monetary history, but it has another important feature. It is heavily used in industry. That means silver can receive demand from two different directions at the same time, investors seeking protection and businesses needing the metal for production. This creates an important difference between the current environment and many earlier precious metal cycles. A rise in gold, driven mainly by investment demand, can eventually slow when investor interest fades. Silver can face a more complicated situation because industrial demand may continue even when investment demand changes. If available supply cannot increase quickly enough, prices can remain under pressure for longer than many market participants expect. The larger issue, however, is the relationship between debt and money. Governments can raise taxes, reduce spending, borrow more, or rely on monetary policy to manage financial pressure. Each choice has consequences. When debt becomes extremely large, policymakers have less freedom to keep interest rates high for long periods without creating additional pressure through rising debt service costs. That is where precious metals become strategically important. If investors begin to believe that future policy will require easier financial conditions, greater liquidity support, or a weaker real value of the currency, gold can become more attractive. Silver can benefit from the same monetary forces while receiving additional support from industrial demand. This does not mean prices can only move higher. Gold and silver can still experience sharp corrections. Markets can become extremely volatile, and investors can be wrong about timing. But a temporary decline would not necessarily mean the larger structural trend has ended. The deeper question is whether the market has entered a period where previous price levels should still be treated as a destination. If debt continues expanding, if monetary flexibility becomes more important, and if physical demand for precious metals remains strong, the old definition of expensive may gradually disappear, and that leads to the next part of the story. Because the clearest warning may not be coming from the gold market at all. It may be coming from the U.S. Treasury and the bond market. The most important signal may not be visible in the price of gold at all. It may be developing inside the market that determines how the United States finances its enormous debt, the Treasury market. For many investors, Treasury bonds are considered one of the safest assets in the financial system. But safety does not mean the market is free from pressure. When government borrowing becomes enormous, even small changes in interest rates can have large consequences. Higher yields may attract buyers, but they also increase the cost of servicing government debt. That creates a difficult balance. The government needs to continue borrowing. Investors need to remain willing to purchase that debt. At the same time, policymakers have an interest in preventing borrowing costs from becoming too disruptive. When these forces collide, the Treasury market can become a warning signal for the broader financial system. This is where the recent change in the market becomes important. When policymakers begin discussing ways to support liquidity and improve conditions in the Treasury market, investors should pay attention to what that action really means. It may not be officially described as a major monetary expansion. It may carry a different name, but the economic effect can still matter if the system becomes increasingly dependent on policy support. The distinction is important. Traditional quantitative easing is widely understood as a central bank purchasing financial assets to increase liquidity and influence interest rates. Other forms of market support can be presented differently. Yet the larger question remains the same: why is additional support becoming necessary? If the answer is growing pressure inside the bond market, then the consequences can extend far beyond government securities. Bond yields influence mortgage rates, corporate borrowing costs, stock valuations, and the broader cost of capital. They also influence the attractiveness of holding cash and other financial assets. When the bond market becomes unstable, the effects can spread quickly across the economy. For gold, this matters because gold does not depend on an interest payment. A treasury bond provides a yield, gold does not. Therefore, when real interest rates are attractive and confidence in financial markets is strong, gold can face competition from bonds. But when investors begin questioning whether monetary policy can remain restrictive while government debt continues expanding, that relationship can change. The same pressure can eventually reach silver. Silver does not respond only to monetary conditions. Its industrial role gives it another source of demand. But when monetary uncertainty increases while industrial consumption remains strong, the metal can become especially sensitive to changes in investor demand. This is why the Treasury market deserves attention. The issue is not simply whether policymakers are buying bonds, supporting liquidity, or attempting to stabilize yields. The deeper issue is whether the financial system is gradually moving toward a world where policy intervention becomes more frequent. If that happens, investors may begin to question an assumption that has existed for decades, that the dollar-based financial system can continue operating under increasingly heavy debt without major changes. That question has no simple answer. But markets rarely wait for certainty. They react to expectations. And if expectations begin shifting toward easier monetary conditions, weaker purchasing power, and continued financial intervention, gold and silver may respond before the broader public fully understands why. The bond market, therefore, may be sending a message that precious metals investors cannot afford to ignore, and there is another problem waiting beneath the surface. Even if monetary demand pushes gold and silver higher, the physical supply of these metals may not be able to respond quickly enough. The biggest surprise in the precious metals market may not come from another interest rate decision. It may come from something much simpler. How much metal is actually available when more investors want to own it? Silver has a unique position in the global economy. It is treated as an investment asset, but it is also a critical industrial material. That combination creates a market structure very different from many traditional commodities. Gold can remain in investor portfolios for decades. Silver, however, is regularly consumed in manufacturing. Once silver is used in certain industrial applications, recovering it is often difficult or uneconomical. This means a portion of annual supply does not simply return to the market when prices rise. That distinction becomes increasingly important when demand grows. Silver is used across industries connected to modern technology, including solar energy, electronics, electrical systems, and other advanced applications. These industries do not necessarily stop using silver simply because the price becomes higher. In many cases, manufacturers still need the metal because replacing it can be technically difficult or expensive. That creates a potential conflict. Investment demand can increase at precisely the same time that industrial demand remains strong. When that happens, the market has only a few ways to respond. Existing inventories can be released, recycling can increase, mining companies can attempt to expand production, or the price can rise enough to encourage additional supply and discourage some demand. The problem is that mining does not move at the speed of financial markets. A new mine cannot simply appear because silver suddenly becomes more valuable. Exploration, financing, permitting, construction, and production can take years. Even existing mines cannot always increase output immediately. This creates an important difference between financial demand and physical supply. Financial investors can move billions of dollars into an asset within hours. Physical production cannot respond within hours. That imbalance can create powerful price movements. There is another factor that deserves attention: the difference between paper trading and physical ownership. Futures contracts and other financial instruments can represent enormous amounts of silver exposure without requiring every transaction to involve immediate physical delivery. Under normal market conditions, this structure can function efficiently, but during periods of unusually strong physical demand, the relationship becomes more important. If investors begin demanding actual bars and coins rather than simply financial exposure, inventories become increasingly relevant. Premiums can rise. Delivery conditions can tighten. Dealers can experience shortages even while financial markets continue reporting a quoted price. This does not automatically mean the market will experience a shortage. It does mean that availability can become a much more important part of price discovery. Gold faces a different supply structure. Much of the gold ever mined still exists because gold is rarely consumed permanently. Silver is different because large quantities have moved into industrial applications over many decades. That difference could become critical if monetary uncertainty encourages more investors to seek protection while industrial demand continues expanding. The result would not necessarily be a smooth upward move. It could be much more volatile. Prices could surge, correct sharply, and surge again as investors react to changing inventories and expectations. Such conditions often create confusion because the financial price can move faster than the physical market can adjust. And that leads to an even more important question. If physical demand begins tightening the silver market while gold continues attracting monetary investment, which part of the precious metals market will institutional investors notice first? The answer may be found in the companies producing the metal, because when mining profits begin changing dramatically, the market may be signaling that the new precious metals era is already further along than most investors realize. The final question is no longer whether gold and silver can rise. The more important question is whether investors are prepared for a world in which the prices considered expensive today eventually become the prices of yesterday. That possibility begins with the relationship between monetary policy, debt, physical demand, and investor behavior. None of these forces guarantees higher prices. Markets can fall, sentiment can change, and unexpected economic developments can interrupt even the strongest trends. But when several structural forces move in the same direction, the definition of value can begin to change. Gold sits at the center of that process. If government debt continues expanding while policymakers face increasing pressure to keep financial conditions manageable, investors may place greater importance on assets that are not directly dependent on government credit. Gold has historically served that role. It is not tied to the success of one company, one industry, or one government's ability to repay its obligations. Silver adds another layer. Its industrial demand means that its future is connected not only to monetary confidence, but also to the development of modern energy and technology. If industrial consumption remains strong while investment demand expands, the market could face a combination that is difficult to solve quickly through additional production. That is where the mining sector becomes important. Higher precious metals prices can improve mining margins and cash flow. Stronger financial results can attract institutional capital. Greater investment can increase attention toward mining companies, which can then bring more investors into the broader precious metals market. The process can become self-reinforcing. At first, only specialists pay attention, then professional investors begin noticing the improving fundamentals. After that, larger institutions may increase exposure. Eventually, ordinary investors may begin asking why gold and silver prices have moved so far beyond the levels they remember. That final stage is often where market psychology becomes powerful. People tend to judge prices by the past. An investor who remembers gold at a much lower price may automatically assume that the previous level remains the real value. But markets do not promise to return to historical prices. Currency values change. Production costs change. Debt levels change. Demand changes. Monetary systems change. The price itself may be the least important part of the transformation. The real transformation is the environment surrounding that price. If the dollar loses purchasing power over time, a higher nominal gold price does not necessarily mean gold has become dramatically more expensive in real terms. It can also mean that the currency in which gold is measured has become weaker. That distinction is critical. It also explains why a temporary correction should not automatically be interpreted as the end of a long-term trend. A structural market can experience severe pullbacks while continuing to move toward a new equilibrium. For serious investors, the objective is therefore not to predict every daily movement. It is to recognize the forces that can change the long-term range. Gold and silver may still experience volatility. They may rise, fall, consolidate, and surprise markets in both directions. But if debt pressures continue, monetary flexibility expands, physical demand remains strong, and institutional participation increases, the old price levels may gradually become less relevant. The greatest mistake may be assuming that the future must resemble the past, because if gold and silver really have entered a new era, history may not be repeating itself. It may be resetting the reference point entirely. And that is the development investors should watch most carefully.